All right, guys, warm welcome to another week ahead video. This week's video will cover the trading week running from Monday the 25th to Friday the 29th of October 2021. Now, our main attention for this week will be on that Bank of Canada meeting coming up on Wednesday. Now, over the past couple of weeks, markets have been getting more and more worried about rising price pressures because we've seen that global supply chain disruptions, they haven't really been calming down as fast as consensus had hoped for. Furthermore, that recent global energy crisis that the world has sleepwalked into, that has sparked a lot of additional inflation concerns. We had energy prices like natural gas, coal prices, oil prices, all of them pushing to the upside, and all of this has played well into the hands of the petrocurrencies like the Canadian dollar. Now, recall back in the first quarter of this year, the Canadian dollar saw a huge appreciation because markets priced in that hawkish tilt from the Bank of Canada in April. But markets, in our opinion at least, going back to May, the markets priced in way too much too quick, and that saw the cat shed some of that froth to trade mostly sideways and range bound throughout May and June before, of course, grinding lower until the middle of September. Now, since the latter part of September, the higher than expected inflation readings coming out of Canada, the much better or faster recovery in the labor market coming out of Canada, higher oil prices, all of that has seen the markets once again reprice the CAD significantly higher. Now, the question is, do the current levels of the CAD look justified? Well, the data suggests yes. If we take a look at the recent data, it's been solid. Headline CPI reaching 4.4%, core CPI reaching 3.5%. That's way above the bank's 1 to 3% target band. Transitory or not, these are crazy, crazy high numbers, right? On the labor side, we are almost back to pre-COVID levels. 4 solid job prints in a row coming in for the labor market. Oil prices have been ripping. Overall risk sentiment has been positive, pushing equities higher once again. Both of that obviously supportive for the CAD from that high beta point of view. The only real drag has been on the growth side of things, where we had that Q2 growth coming in well below the banks as well as the market's forecast. So with all of the information that we have, the move in the CAD definitely does make sense. The markets fully expects the bank this week to follow through with yet another round of tapering to bring the current QE purchases down to 1 billion per week from the current 2 billion per week. Now, because this is already largely expected by the markets from a couple of weeks ago already, the real interesting question for this meeting isn't really going to be on tapering. There is a caveat to that, which we will discuss though, but the real question is going to be how the recent developments, how that has changed the bank's view in terms of interest rates. Now, you guys would recall that the bank has previously stated, really from July, that they will only hike rates when the output gap or the slack in the economy has been fully absorbed. And they previously, from July, they've only seen that happening in the second half of next year. Now, recently, we've seen a massive repricing in money markets, right? We've seen the OIS curve currently implying 3 hikes for the bank by the second half of 2022. If we take a look at the Canadian yield curve, which is the current one in orange, if we take a look at that front end, that 1 year to 5 year, we've seen a huge steepening from just a month ago, which we can see in green, from just 2 months ago, which we can see in red. And this, alongside that OIS pricing, is really looking a little bit overdone for what the markets are expecting right now. If we take a look at growth once again, even though growth has been good for the majority of the year, we did see quite a substantial disappointment in that second quarter print. Q3 right now also looks like it's going to miss the bank's forecast. Not going to be a dismal print like we had back in the second quarter, but it is currently looking like it's going to miss that forecast. Furthermore, if you take a look at the Q3 business outlook survey, that showed that even though inflation expectations have continued to climb, overall businesses and consumers, they saw prices stabilizing and moving lower in the medium term. So maybe this is enough for the bank to stick to the same previous projected rate path. And if that's the case, we could very likely see a typical sell the fact response in the markets, pushing the CAD lower after that BoC meeting. But there's also a chance, that the bank surprises even more hawkish by potentially not just, tapering with 1 billion, but potentially calling an early end to QE, or by acknowledging that, rates are likely going to move a little bit faster, a little bit more than previously expected. Do we think right now the overall context warrants them to be so aggressive? Currently, we don't think so, guys. That would put them, too far ahead of the Fed too quickly. Furthermore, even though inflation is expected to stay above 3% for the majority of 2022, the bank knows that they can't fix the current supply chain disruptions by hiking rates, right? So um, if they just come out announcing that expected 1 billion in tapering and leave their current rate path projections unchanged, the risk is, I think, firmly tilted towards the downside for the CAD as well as short in yields. If we take a look at what's been priced in, keep in mind that rate markets have priced in a higher rate path for very good reasons, right? We've had that solid jobs recovery. We had oil prices up 25% from the start of September. The Business Outlook survey showed strong expectations for firms to continue hiring, to ramp up hiring, to ramp up capital expenditure. So all of that is still positive. So that means that the risks are definitely there that the bank could surprise on the hawkish side. And that means that we should have an open mind and prepare for either eventuality. I think that'll be a very prudent decision. But still, our baseline expectation is for them to potentially disappoint markets in this upcoming meeting. Now, if we take a look at potential hawkish and dovish outcomes on the hawkish side, remember that a 1 billion taper is already fully priced and expected. So for them to surprise more hawkish than that, they will need to announce an early end to their quantitative easing program. If they just come out and just announce 1 billion taper, that's already priced, and that could spark a little bit of a sell the fact reaction. Also, if they bring forward their rate projections to the first half of next year, currently that's still, as you know, in the second half of next year. If they bring that forward, that should also be positive for the Canadian dollar. On the dovish side, again, because the market's already expecting that 1 billion, if they come out and they just announce that, that really increases the risk of a potential downside in the CAD from a typical sell the fact response. And if the bank leaves that rate projection unchanged, saying that no, we still expect that output gap to only be filled by the second half of next year, that will that'll be very disappointing for rate markets, and we could see a substantial repricing in the front end of the curve, and that should weigh on the Canadian dollar in this upcoming week. So for now, based on expectations for them to potentially disappoint, just if you take a look at what's been priced in for rates, what's priced in for the CAD, there's a lot of froth in the market. But we do, like we said, want to keep an open mind for the potential of them to come out a little bit more hawkish by announcing a possible earlier end to QE, announcing a rate path moving forward. That'll just add fuel to that current fire we've seen for the Canadian dollar. So that's all that we have for you guys for this week. Any questions, as always, please don't hesitate to let us know.